scope of financial statement audit. The first one is we must understand the objective and the responsibility of the audit. Second one, divide the statement into cycles. There are 5 cycles. And the third one, know management assertions about the management. Know the general audit objective for classes. And the last one, know specific audit objective for class of the transaction and accounts.
There are 5 cycles of financial statement. Number 1 is sales and collection cycle. The second one is acquisition and payment cycle. The third one is payroll and personnel cycle. The fourth one is inventory and warehousing cycle. And then last but not least, the fifth one is capital acquisition and repayment cycle.
Management assertions. First, management ensure the financial statement give true and fair view in the accordance applicable financial reporting framework. Second, management makes various explicit and implicit assertions. Third, management representation relating to the recognition and measurement in the financial statement.
First, existence. The asset and liabilities exist at a given date. For example, management assets that inventory shown on the balance sheet physically exists and is available for sales. And second, rights and obligations. The assets are rights of the entity and the liabilities are its obligations. For example, management asset that the entity has legal right of ownership to the inventory shown in the balance sheet.
Occurrence are a transaction or event has taken place. For example, management assets that revenue in the income statement represent valid sales that occurred during the period. Okay, next, completeness. The accounts and transactions that should be included are included. Thus, the financial statements are complete. Management asserts that inventory represent all items on hand at the balance sheet date.
Valuation or allocation. Valuation means that the asset and liabilities must be recorded at the appropriate carrying date. Measurement. Measurement means that any transaction must be recorded at the right amount and recorded at the proper accounting period. Presentation and disclosure. Amounts shown in the financial statements must be presented and disclosed properly.
Setting audit objective. There are 2 setting audit objectives. First, general transactions related to audit objective. For example, sales and sales return. Second, general balance related to audit objective. For example, account receivable and account payable.
Transaction-related audit objective. First, existence. Transaction recorded exists. Second, completeness. Existing transactions are recorded. Third, accuracy. Recorded transactions are stated in the correct amounts. Fourth, classification. Transactions in the client journals are properly classified. Fifth, timing. Transaction recorded on the correct dates. And lastly, posting and summarization. Recorded transactions are included in the master files and correctly summarized.
Balance-related audit objective. First, existence, completeness, accuracy, classifications, cut-off, detail tie-in, realizable value, right and obligations, and the last one is presentations and disclosure.
Test of controls. The auditor will test the effectiveness of the control. Substantive test of transactions. Auditor evaluate the client's recording transactions by verifying the monetary amount of transaction. Relationships amongst management assumptions, audit objectives, audit procedures, and audit evidence. First, management assumptions are contained in financial statements, and then auditor develops audit procedures based on management assumptions. Next, audit procedures are conducted to test the audit objectives. Lastly, audit evidence is developed to support management assertion.
Internal control. Internal control is process designed and affected by those charged of governance, management, and other personnel to provide reasonable assurance about the achievement of the entity's objective. Objective of the internal control. There are three. The first one is reliability of the financial statement, the effectiveness and efficiency about the operational of an entity. The third one is the compliance with law and regulations. The purpose of internal control to ensure the business is conducted efficiently, including adherence to the management policy, the safeguard about the asset, the prevention and the detection about the fraud, and the accuracy about the accounting statement.
Control environment includes governance and management function and those who charge with attitude, awareness, and action concerning the entity's internal control and its importance. Control environment sets the tone of an organization, influencing its consciousness of its people. Risk assessment procedure. The audit procedure performed to obtain an understanding of the entity and its environment. A process of entity identify and manage its business risk. A client business risk can arise and change due to the change of operating environment, new personnel, new technology, new lines, and so on.
Information systems relevant to financial reporting. The components of internal controls include financial reporting systems and consist of the procedures and reports established to initiate, records, process, and report entities' transactions, and to maintain accountability for the related assets, liability, and equity.
Control activities. Control activities refers to the policies and procedures that help ensure that management directives are carried out. For example, that necessary actions are taken to address the risks that threaten the achievement of the entity's objectives. For example, control activities of the organizations are division, segregation, and coordination.
Importance of internal controls from two perspectives, management's perspective and auditor's perspective. From management's perspective, internal control can meet its stewardship responsibilities, and then it can safeguard its assets and records. Operations can run with effectiveness and efficiency. Internal control also make the information reliable so that they can make decisions. Also, internal control can encourage adherence to describe policies, and then they can comply with the Companies Act 2016. The importance of internal control of auditor's perspective. First, to plan the audit and develop an effective audit approach. Second, assurance about the reliability of data. Third, the assets and records of the entity are safeguards. And fourth, entity's ability to record, process, summarize, and report financial data consistently.
Inherent limitations of internal controls. Internal controls can provide an entity with only reasonable insurance about achieving an entity financial reporting objective. The likelihood of achievement is affected by limitations inherent to internal control, such as human error, IT glitch, cost constraints, management override, and company size.
Test of controls. Tests performed to obtain audit evidence about the operating effectiveness of controls in preventing, detecting, or correcting material misstatements at the accession level. Test of controls. Tests performed to obtain audit evidence about the operating effectiveness of controls in preventing, detecting, or correcting material misstatements at the accession level.